Hello, my name is Yvette Jacobs-Lee and I'm the tax partner in our family business sector group. And I'm here today with Rob Edwards, who's a financial planner in Moore Kingston Smith Financial Advisors. And we're going to talk to you a bit about the biggest changes to inheritance tax, I think in a generation. We've got some huge legislative changes happening in the next year or so. And really this is the time now to plan and act for what's coming up. This particularly applies to clients with trading businesses, where at the moment we have an unlimited inheritance tax relief for passing on the value in your family trading business. From April 2026, that unlimited allowance is going to be capped at £2.5 million of value. So if your business is worth more than that, or your interest in the family business is worth more than that, there's going to be a new inheritance tax charge for value that passes after April 2026. And that inheritance tax rate is half of the main inheritance tax rate. So at current rates, that's 20%. But this could be a huge inheritance tax charge to plan for in your family business. So there's a few areas, Rob, that I think are worthy of consideration for clients at this point. One is to think about valuation, so to understand the tax value of your business, which is likely to be different from the third-party sale value of your business, but to understand what that value is, and so to consider what your exposure to inheritance tax might be. So for clients with particularly fast-growing businesses, this change could be a real issue. And we can help manage that by freezing the value of the business and passing that growth value onto the next generation early. And indeed, lifetime gifting or early gifting might be the strategy that you use to manage the new charges in your business. And for some clients, gifts into trust may be the answer. Trusts pay inheritance tax every 10 years on the anniversary of their creation, but that charge at 3% can be much more palatable and easier to plan for clients rather than a 20% charge on death. So that may be a good answer for your family business. But for some clients, planning to reduce the tax may not be the answer at all. But for businesses that perhaps are asset rich and don't have much cash, liquidity and how we manage that could be the answer to the changes.
Yeah, for those sort of clients, one way to fund the tax is through the use of an insurance policy. That policy is called a whole of life policy, and the clue is in the title. You take out a plan that will insure you for the rest of your life, so you've got a guaranteed payout. Now, the earlier you take out this policy, generally, when your health is better, the cheaper the premiums, and you can either insure yourself with a guaranteed premium, that means the premium is the same throughout the whole term of the policy, or you can get a premium that goes up in stages every 5 years, where you redeclare sort of your health and goes up with age. So there's two different ways of ensuring that. One's slightly cheaper than the other, the non-guaranteed versus the guaranteed, but it's a really good way of ensuring the inheritance tax bill that you'll pay on death if you don't have the liquidity in your company or your other assets.
Yeah. And for some clients, Rob, I think that is going to be the answer. We're not planning to reduce the tax so much as planning for how the family are going to fund it. And so we've options to help there too. But I feel the key takeaway probably for every client with a trading business, if you haven't thought about your succession plan in the last 2 to 3 years, now is the time to review it and address it before those changes come in. And you can still think about the alternatives you have to act. So not all clients have trading businesses, Rob, but business relief has still been very valuable to clients who may well have invested through an AIM portfolio to access the business relief exemption from inheritance tax.
So the relief on the AIM portfolio is halved. So from total relief against inheritance tax to essentially now, instead of 40%, 20%. So that relief is halved, which means an AIM portfolio, when you have an AIM investment, you're investing in companies that are small and medium-sized companies rather than blue chip companies. So there's an element of risk there. What you can do, there is another option with what's called an inheritance tax scheme, which also attracts business relief. and that business relief is generally granted as all business after 2 years. However, because you're already in a name portfolio, you can transfer the assets into an inheritance tax scheme and retain the relief you already have. And the risk in the inheritance tax scheme is similar to the AIM scheme. So we're looking at that for clients if it's right for their circumstances.
Right. So that could be a really great solution.
Yeah.
Clients who are sticking with their AIM portfolio won't be able to access that 2.5 million lifetime allowance for business relief, but then moving into the inheritance tax scheme, it sounds like they will. So, yeah, great.
Yeah, so those pension changes mean that from 6th of April 27, pensions are included in your estate for inheritance tax purposes. At the moment, they're outside of your estate, so for a lot of clients over the last 10 or so years, we've been keeping the pension, not withdrawing income from the pension and keeping the pension asset till last, and then they can be passed down beneficially or without tax to the family. In future, what we'll look to do is take more income earlier from a pension. So instead of using your savings, maybe in your 60s, you'll start to use your pension. This will deplete the pension asset and mean there's less to then come into the estate that's subject to inheritance tax.
Yeah, this is a big change. For many clients, their pension savings has been the most inheritance tax efficient thing that they have, really. And certainly that pensions last philosophy in spending the pension savings is turned on its head now, isn't it? So it's definitely an area to think about and to review what you're doing. But we need to remember, of course, the interaction with income tax. If we're drawing more pensions, we could be paying more income tax. And so we need to think about that also.
That's right, yeah. What we'll look to do is take clients up to the tax thresholds. So if, say, they're getting a state pension, which is roughly £1,000 a month, that will utilise their personal allowance. But we might look, if they have sufficient pension funds, to take out another sort of 37,500, 38,000 at 20% tax. So they're going up to the higher rate charge on income tax. To use that again in their lifetime, or potentially gift that down the generations, gift that to their family, because they can, if they have surplus income as a client, they can gift that, and then that will be outside of their straight away. They won't have to wait 2 or 7 years.
And you're absolutely right, Rob. Those gifts out of excess income is a hugely valuable inheritance tax planning tool, and one that we'd love to talk to you about. In line, indeed, with all these changes, we'd love to talk to you about it. So please get in touch.